Thank you so much for being here today. My name is Yomi and I have the pleasure of recording Pastor Joe's videos every single week, so I'm here to thank you for watching our YouTube videos. I also want to let you know that Pastor Joe has a website, he has a YouTube, he has a Facebook, he has an Instagram, a TikTok. So if you're not connected to any of those things, I think you should stop what you're doing and go follow, like, comment, share to all of your friends that may need the content that he's sharing. If you have any questions, comments, or suggestions, our information is on our website, so please feel free to reach out anytime. Now, without further ado, here's another one of Pastor Joe's videos.
Hey guys, welcome to Joe Knows. I'm so glad that you're listening in. We've been talking about finances, and last week I talked to you about how to buy your first house, and hopefully you're thinking about that, getting things in place. And if you didn't get to listen to it, go ahead and listen. But once you have your first house, now you're actually in the market. So you own a house, and as houses go up in value, which they always do, your house, you already own your house, so as they go up in value, your house goes up in value as well. So that's a good thing, but it's really not creating wealth for you because it's the house you live in. And if you sell it when it's worth a lot of money, the house you buy is also going to be worth more money. So it just kind of keeps you at pace with the growing market. Now, what I want you to do is, I told you I want to talk to you about creating wealth. What I'd like you to do is think about that first house becoming your first rental house. And when you have a rental houses create wealth for you. Let me tell you the 4 ways that a rental house will put money, wealth, in your pocket for the future. The first thing is, you're going to have a mortgage, but it's likely that your rent is going to be higher than your mortgage payment. So the first thing is, you're going to have a positive cash flow from renting the house. It's going to be probably more than what your mortgage is. So that's number 1. Now, I would recommend that you not spend that money. Keep that money in a separate bank account, because you're going to have repairs that you might need to do. You might want to upgrade the house. So, but you're going to have a positive cash flow from the rent. The second is, you actually are going to get a 20-year write-off. You're going to be able to depreciate the house over 20 years and get a tax write-off. So you say, what do you mean, Joe? Didn't you tell us that houses are appreciating assets? They go up in value? Yes, but the government, for some reason, allows us to write off a rental house. So if you pay $300,000 for a house, you have 20 years to get a $15,000 write-off for that house. That means that will be a tax deduction that will lower the amount of money that you pay in tax. That's the second way you get a tax benefit. The third is, when you have a mortgage, say you have a house that's about $300,000, say your mortgage payment is, including taxes and escrow, say it's $1,800 a month. A portion of that payment goes to pay down what you owe on the house. It goes to principal. Okay, so if that number is $300, that means of that $1,800 payment that you're making, $1,500 is an actual expense, but $300 pays down what you owe on the house, which really is creating wealth for you. You're paying down what you owe on the house. Now, every time, mortgages are usually 30 years, and over the course, the lifetime of the loan, the principal and interest are going to add up to the same thing. But if the first payment you make, if you pay $300, goes towards principal, and the other amount goes towards the interest, the next month it'll be about $302 goes towards paying down what you owe, and a little bit less on interest. And that happens for the entirety, the life of the loan. When you get to about 15 to 20 years, it's about even. So the same amount of money being paid, but half of it going to principal now, the other half interest. And as you get further on in the loan, it'll be less and less. And you get to a place where most of your payment is not going to interest, it's paying down what you owe. Now, what I'm going to teach you in the next session is, we really don't want to pay houses off, but if you were going to pay it off, anything that goes to principal is not an expense. It's putting wealth in your pocket. It's increasing your asset and your equity in the house. Okay, so I said there are 4 things. I just told you 3. The first one is, you're going to have positive cash flow from the rent. The second is, you're going to be getting a tax write-off. The third is, you're going to be paying down what you owe on the house. But the fourth trumps all 3 of them. put together. And that's the house that you own, that you're making payments on. Really, you put very little down on the house, but you own the house, and as the house goes up in value, it's all yours. Now think about this. You buy a $300,000 home, and you put down 10%, that's $30,000. But you, as that house goes up, maybe 5%, maybe in a great year, 10%, we've had some years in the past, 20%. If your $300,000 house went up 20%, that would be $30,000 that it increased in equity. You do not have to share that with the bank, even though they own the lion's share of the property. But you have the deed. So what we want you to do is think about turning that first house that you're living in, your first house, turning it into a rental house as soon as you possibly can. Now, the thing that's going to hinder you from buying your second house is you don't have the down payment. Now, there are ways that you can do that, and I'm going to explain that to you next week. But I want you to understand that if I'm 64 years old, I've owned houses in New York City, I lived in San Diego, I owned a house in New Jersey. Every time I moved from one house to another, I would sell my house to get the down payment and buy the next house. That was a mistake. I could have accessed the equity. The equity in a house is the difference between what the house is worth and what you owe. I could have accessed the equity and used that to buy my second house, but I could have kept the asset. I could have kept the house. I didn't understand that. If I did, I would have many, many millions of dollars of houses in my portfolio. But I didn't, but I figured it out when I was 50. And I'm now 64 and I own 17 houses, and I've been able to do it by and large. The money, the equity in the houses I've owned have paid for me to buy my next houses. I'm going to show you how to do it next time. Be listening in. Listen to these things over and over again, because every time that you listen, it's going to sink in just a little bit more. So God bless you. I'm looking forward to talking to you next week.